When I ask a stock picker what he likes best right now, this is not what I expect to hear in response.
The top of my list today is cash. Cash is an asset class. Cash is an investment. Here's what people don't talk about enough when it comes to cash: the option value of cash, the optionality. Here's the deal. The best investment advantage you or anyone else can possess is having cash when no one else does. Being able to buy when others are forced to sell is a massive advantage. It's historically been the basis of huge fortunes.
That's Stephen Gray of Gray Value Management, a hedge fund manager who is a valuation investor. And with valuations where they are, he's talking about cash and the options that holding it gives you and the potential that it will become a lever to future success. But he's also talking about what stocks he does like in today's market call. But up first, John Colescott, president of CEF Advisors, returns to the show to talk business development companies and what he picked up about industry changes and more at the recent Eversheds BDC Roundtable, one of the biggest conferences in the industry. Plus, we've got Ted Rossman, senior industry analyst at Bankrate.com, and he's here talking about a part of inflation you haven't really thought about, which is how inflation is impacting your rewards points and more, as well as the credit equations for using your credit cards.
Thank God it's Friday!
It sure is Friday, and this is Money Life for Friday, October the 17th. Yeah, I won't mind this weekend coming up. No, I've got a lacrosse tournament. I've got one of my best friends in town, so I know it's going to be a good weekend. If, by the way, if you're one of the folks, and I know one or two of you have done it, if you see me on a lacrosse field officiating, find another time to talk with me and maybe don't be yelling at me if you see me there. Like,
Hey, Fatso, let's go!
you would not be the first person to yell that to me on the field. It would be, I hate to say that, but yeah, if you happen to be at this tournament, because Gail's actually going to be there at this tournament with me because we're going out to see, when we're done, Rob Floyd's band, Sonic Union, one of a couple of bands that Rob is in, but Rob Floyd's band is playing, so we're going to have a really nice weekend. We've got that ahead, something to look forward to. But before we get there, we have a great show to get to. I do want to point out that yesterday I mentioned that our show was up late and that it was my fault, which it was completely my fault until we posted the show at about 12:30. And as of the time I am recording this, which is on Friday morning, the show still was not up on Apple Podcasts. We do understand how much you guys are disappointed when it's not there. You can use the RSS feed that's on our show. You can go to moneylifeshow.libsyn.com. You can try other podcast links. There's a service called pod.link. If you go to pod.link and you search for Money Life, it'll bring you to our page, which literally shows every single episode, but it also shows every single place that carries the show so that you could just start checking out other podcast apps if you need to. We still want to know that you're having the problems. Trust me, we are working on them, trying to do the best we can, but there's not much we can do when we post the show. And a couple of them like, yeah, no, it was on me. And then we posted and you're still not getting it. It's super frustrating for all of us. I love the feedback we've been getting. We've had a lot of contest entries this week. We'll have a contest for Jeremy Kyle's book next week. And it won't be the only contest we're having because we got a couple of different books, a couple of authors coming next week with some great stuff. I'll tell you more about what's coming at the end of the show. But right now, let's jump right into it because we got great things to get to. Again, it's John Colescott, Ted Rossman off the news with this different take on inflation, and then Stephen Gray with a fabulous market call. Thanks for being here. The talk starts next.
If you like the Navigator podcast, you'll love the Active Investment Company Alliance 7th Annual Roundtable, being held November 19th in New York City. You'll dig into current investment strategies, the latest trends, and new developments in the closed-end fund industry, with informative panels and engaging speakers, many of whom you've heard on the Navigator. And we'll get to network with leaders in closed-end funds, interval funds, and business development companies. AICA events are known for high-quality, advisor-centric content. You'll get to engage in meaningful discussion and interaction with the industry's top minds. Advisors can get 7 CE credits for attending. Complete details are available at aicalliance.org/event. Use the code NAVIGATOR30 for a 30% discount.
We're getting the latest update on business development companies from John Cole Scott, president of CEF Advisors. Welcome to The Navigator. This is The Navigator, where we talk about all-weather active investing and plotting a course to financial success with the help of closed-end funds. The Navigator is brought to you by the Active Investment Company Alliance, a unique industry organization representing all facets of the closed-end fund industry, from users and investors to fund sponsors and creators. If you're looking for excellence beyond indexing, The Navigator will point you in the right direction. And returning to The Navigator today, John Cole Scott, president of CEF Advisors in Richmond, Virginia, which is online at cefdata.com. But beyond CEF Advisors, John is the chairman of the Active Investment Company Alliance, which you can learn about at aicalliance.org. John Cole Scott, great to have you back on The Navigator.
Always good to be here, Chuck.
Business development companies have been a compelling investment story this year for a lot of different reasons, not the least of which is the big yields. You and I spoke about them not too long ago on The Navigator, but you were just at the 22nd Eversheds BDC Roundtable in Washington, D.C. And it's a big deal in the industry where a lot is discussed about what's happening and how structure and rules are changing and how politics is impacting the industry and more. Because business development companies, and for anybody who is listening to The Navigator and says, you're about closed-end funds. Yeah, technically a BDC is not a closed-end fund, but we lump them together because they have all the same attributes, just a slightly different exchange structure. But we're looking at BDCs, and they've been in the news because there's a lot going on with private credit, et cetera. So we should tell people the Eversheds conference is all about the legal side of the industry. And one of the things that has been happening with BDCs, closed-end funds, private equity, and more is that the rules keep changing, and a lot more people can now access BDCs and private credit. So let's start there. How much wider is access going to become?
Yeah, so I'd say really the one thing we love about the conference is it allows me to hear the lawyers and regulators and valuation firms talk to their clients and prospects, not thinking that I'm in the audience deciding what data to collect, what questions to ask, what BDCs to put in client portfolios. Been going there for about 10 years. So it's a great resource with what they put together. And really, I mean, if you think about what's going on, like President Trump said, we should only allow stocks, which includes BDCs kind of as well, to only require semi-annual reporting. And they gave a great feedback on that. Well, if that becomes the new rules, they still would expect that most BDCs will report quarterly, because how are you going to get these quarterly private marks? 4 net asset values a year doesn't seem like enough sometimes. I could never imagine buying only 2 a year in my database. And you really got to look at that updated leverage and non-accruals and all those data points we talk about to really understand which managers are doing better. How are they considering leverage? How are they raising capital? How are they treating shareholders? That huge mark of all the holdings marked every quarter is a really boon for the sector and a really wonderful part of being a BDC investor. And we really plan our life around these rhythms of quarterly earnings season, which is about to start for the third quarter in the sector in a few weeks.
Yeah, I certainly hope that we don't get to where we get less regular reporting, because the reporting is important with all public companies, but BDCs, where you're dealing with a lot of stuff that's happening behind the scenes, it's not as easily watched. I think the loss of numbers would be a big deal. So that is definitely one thing that's happening. Of course, you talked about politics and policies right now. What else do we need to know about the rules and what's going on? Because there are changes to some of the access and how people are going to access BDCs and how BDCs are going to be packaged.
Yes, to be fair, we're not just talking about listed exchange-listed BDCs. We're also covering the non-traded, which is generally sold to retail through the wealth channel, as well as private, which is generally sold through the institutional channel to accredited investors and qualified purchasers. But what's interesting about the structure for both of it is the acquired fund fees, which is getting more impactful for listed. We've talked about before. It's gotten through the House. It's stuck in the Senate. One of the cool things we learned at the conference is the actual role of lobbying and the fact that a New York senator is no more power than an Idaho senator, and really going and finding the stories in the portfolio. So one thing we did at CF Data is we've got almost all of the portfolio holding companies, corporate headquarters by zip code, to then give to the lobbyists, because that's not what we are, to try to help push the needles towards that ruling. There's also, we talked about the tax parity, where BDCs were excluded from the way that MLPs and REITs are taxed for people that are income investing. There's a chance to move that forward because it really wasn't a contentious issue in Congress. It was more overlooked because a smaller bucket of those that use them. And then the really why do we even have BDCs? It's for capital formation to promote small business growth. And we really recognize that you must work through the staff because congressmen are busy. We even heard from a congressman in New York on the finance committee about how his staff, he's a finance staff member that digs in all these issues. So he really tries to bring the light when the vote comes up. He looks to his guy or girl and goes, should we say yes or no? And if we can get to those people, we can hopefully make these things happen, which would be dramatically useful to retail investors, income investors, and financial advisors that serve them.
Yeah, of course. Right now, they're not looking to their people and seeing anything because the government is shut down. That's going to hold up a lot of things. It's also going to create more of a backlog for changes going forward. So that may slow some of this progress that I think BDC folks were expecting.
It is. And then they also talked about the regulations and how, in some ways, so one point they brought up at the conference was that the last commissioner said that, oh my gosh, now 20% of investors are accredited and we need to bring it back down to five ish. And the current footing feels more like it's 20, it should be 50. And so, just by the feeling of the priorities of the commission, we had the current commission, he actually had a fireside chat with the head of the practice and really thinking about what I heard the lawyers tell the BDCs is, okay, you still got to worry about doing the right work. You can't make mistakes. You will get in trouble. One interesting thing they said, well, if we find a problem, should we serve it on a silver platter to the regulators? And again, one of the reasons why I love to be in the room, Chuck, they go, well, you should be prepared to answer for it when you found it, how you corrected it, but wait till they find it too, which unfortunately seems to be relatively normal in capital markets in most places, not just the US.
That's also why regulators close the barn door after the horse is gone. They're always kind of looking after the last problem, not the next one, because they're not trying to solve it.
But also, if you imagine, I imagine with the priority of AI being brought into money, that's government, they'll be able to go through much more data far more quickly to look for things like this that I think done right will bring more problems to light and create a better experience for most investors in the market.
A lot of things like private credit, which is the heart of the BDC business, are now going to be more readily available in retirement plans. What does that do for the BDC business? Does it create more demand for BDCs so we'll see more product creation, or does it just create more opportunities so the big BDCs will become the bigger BDCs?
Well, I mean, there's more BDCs forming. We have 116 non-listed private plus the 51 listed. We just crossed the $500 billion asset mark in CF data while at the conference. But they focus heavily on you got to make sure that your fund isn't more than 25% in a retirement plan, or there's ERISA rules, which in some ways are beautiful, but create tons of complicated rights for investors and class action lawsuits. And they want to make sure that that is something that if you're going to bring these products into these plans, you're very thoughtful on the sizing that is in these plans. But however, they also said there's a benefit to BDCs because of their 40 Act, their independent board. They are a registered fund product. They're probably generally the better structure than a private fund. We learned about these new things that I never heard of, Chuck, these venture capital operating companies, where from my understanding, talking to people that create them, they do a prospectus, they collect capital and never report more data again, which I can't imagine that's true. But I heard that from a guy that creates them for a living at a firm I won't share. And I was like, BDCs are much better structures because of the transparency, because of the limits on leverage. And even heard from a BDC that we go higher leverage, but we won't get investment grade rated. So our leverage will cost more if we go up a little bit higher. So we can't raise more debt capital because we want to make sure we keep our investment grade rating. So even the lenders help keep BDCs in check, which is a really interesting thing to learn about.
Yeah. And it's why investors need to look under the hood and understand the credit quality that they're buying into and all the rest. So, what does this mean for BDCs, or maybe more importantly, for investors in BDCs moving forward? Because the yields, they're going to stay attractive. They have been very attractive. They're going to stay attractive. But the environment is changing. And that also means the rate environment as we're watching the start of rate cuts. So, what's the near term outlook for you?
There were 11 panels and I think 12 hours of content. So this is definitely a summary version of what we learned. But I'd say what we think we learned is there's a lot of people thinking about PIK. And, oh, PIK, it must be terrible to not get paid. And they made it very clear to their peers and the environment that when you put a deal together where PIK income or payment in kind is part of the plan, part of the deal and the structure, it is a useful tool. It's different when you plan not to get picked and then bumps happen, the company's in trouble, and then pick is the only way to keep it solvent. That's a much less common situation, but we definitely learned how the BDCs think about that one data point differently. And then we think about how they're looking at how they keep their leverage at a certain level, they keep their equity capital growing. Imagine a public BDC can always bring new stock to market, but if you do it aggressively and frustrate shareholders, not just institutional, but even retail, they tend to trade you worse. And we also learned there's a lot of unique strategies. Imagine there's some BDC like Ares Capital that do potentially everything bottom to top, are relatively unique. There's lots of only larger. And there's a bunch of smaller ones, like we had Gladstone at the conference last summer. There's ones like Capital Southwest, Main Street, even Trinity that do a lower level of size. But the way they structure their deals, there's so much uniqueness here. And it's so hard because so many investors sift on two things, Chuck: discount and yield. And I've said this for the 6 years we've done the podcast. It's always more than that. It's manager quality. It's how they care about leverage. It's how they look at their fee structure. It's how they choose to grow and what their ROE and NAV performance and all those important minutia. And the cool thing is, as I said over and over again, the diversity and competition has brought fees down a little bit and is creating more better quality managers. But like you said, there's like JP Morgan. I met with them after a previous conference. They have yet to launch their BDC. I said, you're a little bit late to the party, but you'll probably get to $1 billion by snapping your fingers because you're JP Morgan. But more are coming. But I love the competition because, as you might know from most fund structures, competition squeezes fees. And I think that's good for my clients and good for your listeners.
The other thing that it does is it makes it that there's going to be more BDC oriented products. They may not be the individual BDCs, but they'll be the funds or the ETFs of BDCs. So an ETF of BDCs, we're seeing more of those come to market as well.
We recently had a First Trust Conflict product become from a closed-end fund to an active ETF. It's still very small and gaining traction. There's a more mature Putnam fund, and there's other more passive and growing strategies. There's even talk at the conference about private equity and private credit being in an ETF wrapper, but they said definitely look under the hood. It's usually through wrappers like a closed-end fund or BDC in the guts of an ETF, or it's going to be a derivative-based strategy. It's nearly improbable that you could load up an open-end fund wrapper with illiquid things you can't trade regularly. Even the BDCs themselves rarely trade their holdings amongst each other, and they're a relatively small group. And so I'd say whether it's a closed-end fund, an interval fund, a tender offer fund, a BDC, listed or private, a lot of interesting places there. And then the investors in these funds are very different. You and I, we like things that we can see on the stock exchange. If we want to, we can trade them. I don't dislike the private and non-traded, but I like more control over choice. And I've taught my clients volatility can be an asset, not a deficit to the experience, because we change our minds with conviction regularly. So I think there's really interesting things. There's even a white paper out now about an interval fund electing to be a BDC and not a closed-end fund. And that idea, to my knowledge, didn't exist 10 days ago.
The changes are happening fast. They're making more opportunities. We'll be following them, or more importantly, we'll be having you follow them. John, thanks as always for joining me on The Navigator.
Great to be here, Chuck.
That was John Colescott, the president of CEF Advisors, chairman of the Active Investment Company Alliance. His firm is online at cefdata.com. And if you want to learn more about business development companies, closed-end funds, interval funds, tender offer funds, go to aicalliance.org. That's the website for the Active Investment Company Alliance. We're just getting started on Money Life for October 17th. Later, I'll be talking with Stephen Gray from Gray Value. But next, Ted Rossman from Bankrate.com. We're back on Money Life, where we are going off the news, and we're doing it in a way that I think is really interesting, because we know that inflation is affecting you. You cannot avoid it. It's also affecting things that you might not be thinking about, like your credit card rewards. And it's affecting like your payment process. So there's a great piece out on Bankrate.com that looks at how inflation is impacting rewards. And as a guy who was just making some travel plans and looking at rewards points and doing all the rest of that, I was actually thinking about this. And then the next thing I know, I see a piece from Ted Rossman talking about it. So this is one where you probably haven't thought about the impact of inflation, but maybe you should. Ted Rossman is senior industry analyst at bankrate.com. If you find where we mention him in today's show notes, or you find him on the guest page at moneylifeshow.com, you will find a direct link that gets to his piece on how inflation is affecting your credit card rewards. Ted Rossman, welcome back to Money Life.
Great to be here. Thank you.
Yeah, I have to say I love this piece, and it was literally like you guys put it out on October the 10th, right as I was like making plans of looking at this going, wait, how is this kicking in? So we know that consumers are saying they're feeling the pinch, that they don't really love what they're feeling. But the fact is, points, whether it's airline miles, points on your credit card, whatever it is, and even cash back, all that stuff is its own form of currency. And if it's a currency, it's affected by inflation, isn't it?
Yes, and it's a currency that these providers can manipulate. These airlines and hotels, they can play with the value. And in recent years, they've really devalued a lot of these points and miles. In other words, it's taking more points and miles to get that same free flight or hotel room. Really, the biggest example of this is tying redemptions directly to cost. This is very friendly for the airlines and the hotels. It's not good for consumers, though, because 5 or 10 years ago, there was more of a fixed reward chart. And you could use, let's say, 25,000 miles, and it didn't matter if the flight cost $100 or $800, it was the same 25,000 miles. Now, the higher the cost of the flight or the higher the cost of the hotel room, the more points and miles it's going to take. Some of these shifts have been pretty dramatic, and it's really eliminated a lot of the sweet spot for the redemptions. It's also on both sides of it. It's the redemptions and the earning. You're going to get more miles for a more expensive flight, even if it's shorter. So it's not as many butt in seat miles anymore. It's how much you paid, basically.
Well, the other side of all of these formulas, okay, as a general rule, if I'm using my credit card that I get points on or what have you, well, inflation means I am going to earn more points. But again, whether those points are keeping up with inflation and whether I can redeem them, there's a lot of ifs there. Does it change the value proposition for a consumer? Are we better off saying, hey, if I'm going to be spending more because inflation is up, I'm better off going cash back than points?
It could be. There's been a real tremendous amount of change this year in the luxury credit card space. We've seen refreshes on the Sapphire Reserve from Chase, the Amex Platinum, the introduction of this new Citi Strata Elite luxury card. A lot of people are viewing these as sort of high-end coupon books, if you will, that there's a credit for this, a credit for that, but there's very high annual fees. I mean, we're talking seven, eight, $900 a year for these cards. And there continues to be this arms race to push the annual fee higher. And they throw in perks. I mean, maybe it's money for food delivery or ride shares or digital entertainment or travel or other things, but it's getting more complicated and it's getting out of reach for the typical person. And this is another example of devaluations or inflation hitting your credit cards because the annual fee going up, up, and up is leading a lot of people to say, I don't know if it's worth it anymore. Some of these cards used to be sort of champagne travel on a beer budget. And when the Sapphire Reserve came out, the annual fee was $450 a year. And it was really less than that, though, if you take off the $300 travel credit and the global entry or TSA pre check waiver and the lounge access. And it kind of paid for itself. Well, now it's $795 a year, it doesn't pay for itself quite as easily. If you use all the credits, great. But if you don't, it is leading some people to simplify and say that the travel game might not be as lucrative anymore. Maybe you should switch to cash back. There is still an appeal to the luxury travel stuff, but it's becoming champagne travel on a champagne budget, not champagne travel on a beer budget.
Well, and it raises a really interesting point. Gail, my wife, had never really had frequent flyer miles, is not all that well traveled, and she's been traveling more with me. We finally decided to get her a points oriented card. And it was really, okay, what are we paying for? Are we taking the bonus? Are we looking for other things? And what she was looking for was mostly, I want to save on baggage fees. I want to make sure I'm getting the points, etc. And that's a deal where when we were shopping for it, it was pretty easy. But I was looking at some of those other things more for myself because I do a little bit more with it and going, yeah, I'm not sure I can justify it. So it's really a case of inflation is also making it that you'd better be a better consumer if you want to consider spending more than the base.
It is changing the calculation for sure. Annual fees are getting higher, travel redemptions are getting less lucrative. There's still value, but you need to look harder for it. Some people are switching to cashback for the simplicity and the universal appeal. Some of these trends are still hitting cashback, though. I'm a big cashback card user, and my biggest pet peeve is that these spending caps have not changed in more than a decade. For example, the Amex Blue Cash Preferred is a card that I use personally. It gives 6% back at the grocery store, which is huge for my family of four. We spend a lot on groceries. The problem is that that 6% grocery rewards cap is $6,000 a year, and it hasn't changed in more than a decade. So if you go back to 2013 and you adjust for inflation, that cap should be more like $8,500 now if you're adjusting for inflation. So the net result for me is that my family ends up hitting the cap around mid-year, and then we drop to 1% rewards. I know there are some workarounds. I mean, honestly, we should probably get a second one in my wife's name and maximize it that way. Maybe it's a shoemaker's children kind of thing. I haven't done that, or I could get a different grocery rewards card. But I sort of have a little bit of this axe to grind with these companies that, and it's everybody. I mean, there's the popular quarterly rewards cards like Chase Freedom Flex and Discover It Cashback. You get 5% cash back every quarter on rotating categories, but it's capped at $1,500 in spending. And neither one of those cards have changed their cap in a really long time. I know they don't want to do it every year, but can we get an inflation adjustment, every 10 years? Is that too much to ask? Sorry, I'll get off my soapbox now.
No, I love that you are on the soapbox because, again, I think that these are issues that are out there. So, with these issues, I want to talk about the other side of this, which is for consumers. They worry about, oh, if I'm, doing this stuff, am I messing up my credit score or what have you? And the basics are always that a points card or a cashback card or paying for a card really only makes sense if you're pretty much paying off your card every month. If you're carrying interest rates and you're paying for the privilege of it, you're probably wasting money. So, from that standpoint, the people who are shopping around and going, hey, I got this deal, I took this thing, now I still have it, but I'd rather maybe find a better one. They shouldn't really worry about what they're doing with their credit score when it comes to finding the next card, because the truth is they probably have a good credit score. They wouldn't be getting these deals, right?
That's a great point. Yeah, if you're carrying a balance, the average credit card charges 20%, and that's way more than you're earning in rewards. So if you're in the half of cardholders with debt, pay off the debt first, worry about rewards later. This is a big mistake that more than 7 in 10 people with credit card debt are still chasing rewards. That's a big mistake. If you find yourself disillusioned with some of these changes, you can switch cards. Instead of canceling, I would suggest a product change. It's better for your credit score. You can ask the company to switch you to something else. It's better than canceling and opening something new because you don't want to have too many account openings on your credit file. So, what I would say is call up the company, say, the annual fee is too high. I'm not traveling as much. The interest rate's too high. Whatever it is, do you have something else for me? Get into a better fit, something that targets your spending categories. There's no one size fits all best credit card. And the other thing is, your life changes, the market changes. Every year or two, it probably makes sense to evaluate what you're using.
Yeah, I will point out that I haven't really done as much of that as I should. And of course, that's another area where, you don't want to be paying a $99 fee on a card that you're not using anymore, let alone the bigger fees. But if you're calling up and going, hey, this isn't as useful to me, they may waive the fee, or you can kind of downgrade. I know we're thinking about upgrading, but the idea would be, oh, I take this card and I go to whatever the provider's free card is. And then I go pay my fee as I get the next big, give me 50,000, 80,000 points or whatever for the sign up bonus as I find my new one, right?
Exactly. This has been the year of the luxury card refresh, but these cards are getting out of reach for a lot of people. So if you're not someone who wants to keep using a card that's charging $795 a year or $895 a year, that's the right approach. Call up, ask for a retention offer. Can they waive or lower the fee? Can they throw in a sweetener? If they can't, maybe switch to their no annual fee variety, or maybe switch to a $95 a year fee card. It's not going to have as many perks, but it's becoming harder and harder to take full advantage. You really need to do the math on your specific circumstances. What worked for you at $250 a year or 450 may not still work at 8 or 900 bucks a year.
Yeah. Well, I blanch even at the 200. I'm cheap enough to go. I like rewards, but two more follow-up questions on this, which is, you talked about how you tend to prefer the card that's giving you cash back. I tend to be a points guy. At least used to be that your value tended to be better on points, provided that you used your points. In other words, and that there are some exceptions where you're getting 6% back on certain things. Yeah, that's better than the points. But is that still basically the same? If you're going to use the money one way or another, is points still a slightly better financial deal?
Travel points are generally more lucrative than cash back, but they're more work. And that is a significant obstacle for some people. And when I say more work, I mean, for one, you often need the flexibility to travel on the best days. So if you're like me and you have two young kids in school and you're beholden to the school calendar, we can't just drop everything and travel when there's a flight deal. That's an obstacle for us. And, the other thing when it comes to these travel cards is it is becoming more work to just compare options, find the best deals. Some people really like the simplicity and the universal appeal of cash back. If you get 2% back on everything with no annual fee, something like the Citi Double Cash or Wells Fargo Active Cash, that's honestly hard to beat on a blended basis because a lot of cards have a floor of 1% back or 1 point per dollar. And then maybe there's certain categories that are better, but are you remembering to use the right card? And I use my wife sometimes as a focus group on this because she just can't be bothered with this stuff. And she's always asking, which card do I use for this? And I'm like, oh no, that was the dining card. You should have used the grocery card. And so for some people, they throw up their hands and they say it's too complicated and they just like cash back. If you like travel, though, it is more lucrative. Just be prepared to put in a little legwork.
And then the last question on that, given what you're seeing with inflation, which again is really the point of the conversation here, but also the story that you wrote for bankrate.com. Does it make the most sense? Like if you're stockpiling miles and you're not using them, you're planning. It's one thing if you're saying, I'm planning for that big trip and I need to get those miles up there. But if you've got miles and you've got a trip, use the miles now because inflation's not going to be helping you on this, right? They're every day that you're keeping them, hoping they'll be worth more, they're worth less.
I'm really glad you brought that up. Yeah, it's important to earn and burn your rewards. It's not like your 401k. You don't want to be a points millionaire because these programs do lose value over time. Every year, it seems to cost more miles for that same free flight. So you want to earn them up to a certain threshold. Like, yeah, if you're saving the 100,000 points for the international first class, that's a goal. But if you just have millions and millions of these for really just the sake of hoarding them, inflation is significantly eating away at the value. Every year, the redemption cost goes up. So you want to earn them, but you want to actually use them as well.
Well, that is great advice. It's like all things when you're saving, and people have sometimes a tough time after they go from accumulation to let me spend. Yeah, spend your points, spend your miles. They're not going to be worth more tomorrow than they are today. And again, the whole picture changing. Ted, great stuff. I'm glad that you weighed in on it at bankrate.com and joined me here to talk about it.
Thanks for having me on.
That is Ted Rossman. He is senior industry analyst at bankrate.com. You can go there also to find out all the rates on things that you might be looking for or need for your finances. But the link to the inflation is affecting your credit card rewards story, that's in our show notes and on our guest page. And one thing that is not inflating is money life. We've got the same amount of time and we still have time left. So we're going to make the most of it when we come back right after this message.
Exchange is more than a finance conference. It's a community. Join us to gain insights and connections that last. Visit exchangeetf.com.
Stephen Gray, Chief Executive and Chief Investment Officer at Gray Value Management, is here. We're talking valuation investing. It's time for the Money Life Market Call. Welcome to the Market Call, where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly on the market, and how they are putting it all together. Returning to the show today, Stephen Gray. He is Chief Executive and Chief Investment Officer at Gray Value Management, which runs the Gray Value Opportunity Fund, which is a hedge fund. And yes, you could say that they are value investors, but I would say, having talked to Stephen many times over the years, that they're more valuation investors, which makes this a particularly interesting time to be talking with him because of all the things we've been discussing with everyone else about valuations. If you want to learn more about Stephen and the firm and the fund, it is Gray, Grey, grayvm.com. I will point out as well that next year, probably in the spring, we will be talking with Stephen about his book, The Agile Investor, his first book that he will be publishing next year. But again, if you want to make sure you don't miss that and everything else, grayvm.com. Stephen Gray, welcome back to Money Life.
Thanks very much, Chuck. Good to hear from you.
You're a value investor, but I say you're a valuation investor because it's not quite everybody's take on value investing. And we have really interesting times with current valuations. So I want to break this down. Start by explaining what you do, your take on value/valuation investing. And then I want to go into what you see happening given current valuations on this market.
Well, our approach is anchored in this idea of extreme mispricings. We're drawn to extreme mispricings because they offer the investors the best of both worlds, basically significant upside and a substantial margin of safety. So you're capturing more reward while assuming less risk. These types of mispricings generally don't correct quickly, but we work on a multi-year timeline, so we're largely indifferent to interim volatility, which means that you need to be as well if you want to take this approach. One of the reasons we're able to is because we don't employ leverage, and I'm going to talk about that a little bit later. So we're able to view short-term price volatility as just noise. But it really is, what it comes down to, and this is just a truism that will never change, is that the price you pay drives the return you get. And how you buy determines how much you pay. So another important principle to keep in mind is you want to think incrementally. You cost average your way into positions because unless you have perfect timing, and you don't because nobody does, you want to build positions gradually. You want to be patient and disciplined, but you want to buy value. You want to look for those extreme mispricings where not necessarily value investing, where it's come to be understood as buying stocks that are trading at low PEs, low price to book value, low price to cash flow. But that was not what Benjamin Graham advocated. That was not what Warren Buffett has ever advocated. It's you're buying a discount to intrinsic value, and that's how you're focusing on the valuation to understand what the intrinsic value is and buy at a discount to that. That's the key.
Given where we are right now, with a market that has been flirting with record highs, and we've been watching at least a few things seemingly go to the sky, and we've been watching everything tied to AI get a little crazy. Not 1990s, hey, we've got no earnings, pets.com crazy, but maybe a new take on market crazy. What is your position on just how well or badly valued this market is?
Well, the market certainly looks different than it did when we spoke a year ago. I mean, whether it's the Buffett ratio, which is the total stock market cap versus GDP, the CAPE ratio, price to sales, by almost every measure, the market is trading at or very near all-time highs. Margin leverage in the U.S. stock market is also at all-time highs. ETFs just hit record inflows. There are approximately 900 leveraged ETFs, which they're about 33% of all the new ETFs that have recently come out. That's about $135 billion in leveraged ETFs. So valuations are at an all-time high. Leverage is at an all-time high. Confidence is raging. And by a lot of measures, uncertainty is also extremely high. That's a very dangerous mix. And that's why I think it's very important for investors, for your listeners, to think about being defensive, especially if you're near or in retirement. And that means first thinking about your exposure, making sure that there isn't too much of your net worth invested in assets that could suddenly decline in value, such as equities. Having 5% of your net worth in a stock that drops by 50% and takes 5 years to recover isn't a problem. If you have 40% of your savings in that stock and you're retired, it's potentially a disaster. So I think it's a very, very good time to focus not on the return on your money, but the return of it. And so, where should you start? We usually talk about some favorite names that I have, and I've talked about different stocks in the past. The top of my list today is cash. Cash is an asset class, cash is an investment. Here's what people don't talk about enough when it comes to cash: the option value of cash, the optionality. Here's the deal: the best investment advantage you or anyone else can possess is having cash when no one else does. Being able to buy when others are forced to sell is a massive advantage. It's historically been the basis of huge fortunes. It's also been a key driver of Warren Buffett's long term returns. Is everybody aware of how much cash Buffett is currently sitting on? It's about $350 billion. Now, the biggest challenge with cash is that it doesn't earn you anything. But I have an answer for your listeners on that count. And this, I guess, would be my second investment recommendation for the next step in this thought process. Right now, your listeners can buy a 3-month CD that will pay them an annualized rate of 4%. In my opinion, particularly when it comes to the individual investor, that is very hard to beat. With all of the risks I just listed, and that wasn't even a comprehensive list, a risk free 4% annualized return on an FDIC insured CD beats pretty much every alternative on a risk adjusted basis. And because of the slope of the yield curve right now, you actually get a higher return investing your money for a shorter period. Because time is risk, typically you get a lower return. The 3-month duration of that short term CD preserves that important optionality I mentioned before. Because if you think about it, if interest rates spike, then you can very quickly reinvest in another CD paying a higher return. If the market plummets, you're not locked up for years and unable to take advantage of a sustained market sell off because the CD matures pretty quickly. And the next thing to keep in mind, and this is a really big point, you will sleep well at night. Now, the only last word I would have on all of this advice in investing in CDs is that if you're investing over $250,000, split the money up across multiple CDs so that you stay below that FDIC $250,000 insurance threshold. But I honestly, for individual investors in this environment where valuations are, with the amount of economic and financial risk in the market, the amount of uncertainty, which is extraordinary, I think that 4% is almost impossible to beat, especially on a risk adjusted basis.
Now, you say that knowing, your fund is not 100% cash. It would be an interesting strategy to do. People can't easily find performance on hedge funds, but I know that basically your fund is up in the realm of 40% gross this year. You're not doing that with cash. So how do you square those two things? And, yeah, you can get a good return on cash. And it certainly sounds like you're telling us that, yes, there's a bubble coming, but people are making hay while the sun is shining. So where are you making your own hay? Because it can't all be.
Those returns are in the rearview mirror, right? I mean, it was a number of years ago, I guess not that long ago, I was talking to your listeners about General Electric. We had a very large position in General Electric. We no longer do. It's a great company. It's so much easier to buy one of these companies when they're beaten down than selling them, because it is a great company. It'll continue to perform, but at the current price, it's trading at 50 times a very optimistic estimate of next year's earnings. I mean, almost any investment can become so overvalued that it's foolish to not sell. I talked with your listeners about Agnico Eagle Mines as a way to build gold exposure such that you could actually get paid to own it, because there's the dividend, and because they don't hedge their production exposure, you actually appreciate with gold prices as they rise. And that stock is skyrocketed. I mean, that's where a lot of these returns come from. But going forward, I'm not seeing these opportunities. We've been more monetizing our portfolio than anything else, locking in gains. There are opportunities for your investors if they do, as far as equity exposure. I've talked about Berkshire Hathaway in the past at about 24 times past and forward year earnings. It's not cheap, but if you share even half the concerns I have about the economy and the financial markets, it's the kind of financial fortress you want to live in. And then there's that massive cash pile I mentioned earlier. The market views that latent cash as a big negative. They're kind of wondering, they always start to talk about, has he lost his touch? I view it as a huge positive because when the next market dislocation occurs and prices plummet and firms are desperate to borrow from Berkshire Hathaway, as they were during the great financial crisis, they're going to make an absolute killing. And in the meantime, what can you do? You can sleep at night. So if you're looking for an equity, and again, you have to think about exposure, not just what you're buying, but how much of your net worth, how much of your investable assets are going into it. I think Berkshire Hathaway is pretty attractive. I talked about Remy Cointreau, the cognac company, and Estee Lauder. I've talked about those in prior calls. I think they're still attractive. They're worth considering, but I expect considerable volatility going forward.
Given what you see happening, how much are you selling and what is the sell discipline at a time when, is this about taking profits? Is this about the valuation metric has changed? How are you deciding where you're going to be raising cash at a time when everything does seem to be at least riding the rising tide?
Again, trying to think about it from your listener's perspective. If they look at their portfolio and they realize that they've got a lot more exposure in the stock market maybe than they should be, if they can, let's say the stock market, imagine they took a 30% hit and that would financially really be difficult for them. They can start, and again, it's think incrementally. I keep coming back to that. Shave down all of the positions a little bit. Just start. Say, okay, well, I can't decide what to sell. What I'll do today is, because I understand that I'm overexposed regardless of what happens in the future, I think I'll sell each position 10% and I'll generate some liquidity that way. And so now I've captured those gains did pre-exist, and also I've got that liquidity. Now, when I'm selling, usually it comes down to valuation. But part of it, it's interesting because in many ways, portfolio management is harder than analysis. Recognizing when something is really cheap, for me, is very easy. Recognizing when it's overvalued, like I was talking about earlier, it's harder because if a business is a really fantastic business, how does it ever get too overvalued if it's a fantastic business? Deciding when you have a stable of these companies and you think that you really need to generate some liquidity, and that's the smart thing to do, that's the hardest thing of all. And so what am I doing? I'm harvesting some outsized gains that I've experienced in the portfolio. I'm trimming back some other positions that maybe have some potential, but I'm decreasing our exposure. It's interesting. I mean, if you look back, there are a lot of people, including Warren Buffett, who've said, I don't ever try to time the market. Then you look at what they were doing before Black Monday, before the tech bubble crash. A lot of those, sort of tried and true value investors were just making sort of macro decisions and downsizing their exposure. It's what they were doing. The market overall can become so overvalued. I was talking about this in my most recent partner letter, that you recognize then when there is a correction, the blast radius is going to be so wide, it's going to hit everything. If you think about what happened in that first quarter of 2020 with COVID, everything went down. Now, I don't expect COVID. I don't expect World War III. I'm not saying I have any kind of premonitions or ability to forecast the economic or financial future. Valuations, the market from almost every angle is priced for perfection. Leverage is at extremely high levels. That high leverage means that the higher leverage goes, the less it takes to tip the market over and to trigger an accelerating and self-reinforcing sell-off. That forced selling is what creates that downward momentum, and all of the pieces are in place right now for that. All of them.
Now we're going to get your quick and dirty take on some stocks that my audience is particularly interested in.
Quick and dirty.
Awesome.
Yeah, it sure is awesome when you get to hear the straight take on the market from folks who do it every single day. And my guest right now, Stephen Gray, is Chief Executive and Chief Investment Officer at Gray Value Management. You can learn more about the firm, about the Gray Value Opportunity Fund, a hedge fund, by going to grayvm.com. Gray spelled Grey. You know how Quick and Dirty works? So don't be shy about sending in your picks. But we start today with a pick from Amy in San Diego who wants to know about Brookfield Corp. It's ticker symbol BN.
Big business. They've got asset management. They focus on alternative assets, about more than $1 trillion in AUM. It's a big business. They've got an insurance business that does mostly annuities. They do renewable power, infrastructure, private equity, real estate, and operating businesses. It's very impressive, but it's complicated and it's impossible to analyze in any detail because of all of those moving parts. In my opinion, it's also kind of expensive. Trailing 12-month PE is about 150 times. And even if that's the wrong data point, and you should be looking at, for example, funds from operations. This time last year, the stock was trading below 20 bucks and it's around 45 right now. If you really like it, I would hold fire until you can get it at a more attractive price.
At the same time, it almost sounds like you would go, hey, you got your value out of it. It would be time to sell. Like, are you there or you're hold it if you've got it? You're not buying more until you get that better price.
I certainly wouldn't buy more. And again, it's like I'm not a chartist, but when you can look back and within the last year, the stock was trading at less than half the current price, unless something major has changed, you know, it's appreciated a lot based on probably more multiple expansion than earnings, right?
Okay. So that means
Hold, fire!
yeah, but do not fire on Brookfield Corp until or unless the price shows you the whites of its eyes. It's ticker symbol BN. That is a hold for a better price. Joe in Parker, Colorado wants to know about Bayer AG. That ADR trades under BAYRY.
Hi, Joe. Yeah, Bayer, interesting company. We all know it through Bayer Aspirin. They've got pharmaceuticals, consumer health, crop science. It's up about 60% year to date. I hope you're an owner. It was trading below 20 bucks in January. It's an interesting group of businesses that's basically overshadowed by massive litigation risk. They've got huge liabilities related to both glyphosate, which is the herbicide that is sold as Roundup, and PCBs, which are industrial chemicals that were banned in the U.S. back in '79. And that it inherited both of those via its disastrous acquisition of Monsanto back in 2018. And during Bayer's last analyst call, the word litigation came up over 20 times. When I look at that, I think, what price compensates you for the financial magnitude of that unknowable risk? I don't know. I think that's when you look at that, if you're tempted, if you're in, congratulations. But the future of that company is very, very opaque. When I look at that, as I was thinking about it before I got on this call, I thought, you know what? Why not just buy the cognac that Remy Cointreau sells? It's just so much easier and it tastes wonderful.
So when it comes to Bayer,
Why has my head gone numb?
yeah, well, your head's gone numb because you need more than just aspirin to help avoid the pain that we're talking about. That's a seller and avoid on BAYRY. Again, if you're looking for something different, Remy Cointreau was the buy here. David in Missoula, Montana wants to know about Markel Group, MKL.
David, they do mostly specialty insurance, as you probably well know, and mostly premium insurance, which tends to have better margins than general insurance. I talked about Markel last year, recommending that listeners buy gradually, and I hope they did because they're probably sitting on a nice gain. My advice hasn't changed. Since that last call, I actually had the opportunity earlier this year to sit down with Tom Gaynor, the CEO, at their headquarters just outside of Richmond. Tom is a shrewd, humble, excellent chief executive with Warren Buffett level integrity. I mean, there's nobody in the C-suite of any company I would trust more. I think it's a very good business run by an excellent CEO. I would continue to buy gradually. I think over the long term, that's going to be a great investment. And I think it's also one that has some resilience in terms of, possible downturn going forward.
Just go slow and be smart.
Yep, you're buying in gradually on MKL, Markel Group. Lance in Bethlehem, Pennsylvania wants to know about TPL, Texas Pacific Land Corp.
Really interesting company. They own about 870,000 acres of land and resources in West Texas. Two revenue sources for them: land and resource management and water services. Their main business is oil and gas royalties, which they collect. That's over 50% of their revenue. They own the land. They let other people shoulder the expense of drilling for the oil and taking it out, and they take a royalty. That's a really interesting business. It's basically an asset-light play on oil royalties in the Permian Basin, if you had to summarize it. Here's how I look at it. Think of it as an option on oil prices that never expires. So you're buying TPL is basically a spec on future oil prices because they're getting the royalties on those sales. But unlike speculating via options or futures, you can get the timing wrong with TPL and still not lose your shirt because it's equity. It doesn't expire like an option. Now the shares were over $1,700 this time last year. They're at about, I don't know, a little over 900 right now, which is much higher than the current level. But they've spent most of the last of the 5 years surfing along $500. It's mostly a speculation on oil. So whether you want to buy it or not is based on whether you want that kind of exposure and to an extent where you think oil prices are going. I don't have any opinion on that, but I think it's interesting as a play on that is a relatively direct beneficiary of oil prices as they rise.
Well, I've always been a risk taker.
And yeah, in this case, we're talking about it's kind of a speculative buy. You have to understand that stuff in there, and you may want to wait for a better price on TPL, Texas Pacific Land Corp. And we finish today with a request from Morris in Bradenton, Florida. He shares it with Greg in Tully, New York. They both want to know about Walmart WMT.
Well, I was unfamiliar with this company. I'm just kidding, of course. They got 4,600 stores in the U.S. and over 10,000, probably about 11,000 across 19 countries. I mean, they're massive. What are they? I guess the market cap's closing in on $900 billion. They're trading about 42 times next year's earnings. Between 2014 and 24, like about the last 10 years, their PE is averaged closer to 15 to 30 times. I mean, it's a fantastic company. But when I look at it and I look at their other financial metrics, what I see is in many respects, I think Walmart is expensive even for Walmart. The tariffs don't help them either. Their net profit margin is about 3%. So their costs don't have to rise by much at all to materially dent their profits. And earlier this year, and I'm not including the sell-off in April, the shares were trading below $90. So I think it's an attractive company. I think it's just not attractive at this price. I think it's one to put on your watch list and look for it to trade lower and then take advantage of that. But you want to buy it where it's trading more in line with where it's traded on a PE multiple basis because it's based on its own history. It's really rich right now.
Woo! Somebody done been to the Walmart.
Yeah, they have been to the Walmart, but that doesn't mean you should be buying it. It means that maybe the stock's a little bit overbought here. You should be waiting for a better price. So good company, not necessarily a great stock right now on Walmart WMT. And, well, good stock talk, great interview. Stephen Gray, you never disappoint. Thanks so much for coming back on Money Life.
Thank you for inviting me back. I always enjoy our conversations.
That is Stephen Gray. He's Chief Executive and Chief Investment Officer at Gray Value Management. GrayVM.com, Gray, Grey. They run the Gray Value Opportunity Fund. They are valuation investors, and he's got a book. We'll talk about it when it comes out next spring, The Agile Investor. But we'll come back. We'll tell you where he agreed or disagreed with some recent guests and set you up for next week. Stick with us till the end, please.
Hey Money Lifers, it's Rob Floyd, the show's executive producer, and it's time for another contest where you can win a book that was discussed on the show. This week, you're playing For Financial Success for the Rest of Us, Quality of Life Planning for Mainstream America by Dan Dorval, who appeared with Chuck on the October 9th show. And while the book is all about financial success, the contest is all about Major League Baseball teams that have never had success. Tell us 3 of the 5 Major League franchises that have never won a World Series championship, and 2 of them still have a chance at it this year, and you'll be entered to win the book. Send your answer to chuck@moneylifeshow.com by noon Eastern Time on Saturday, October 18th to be entered for a drawing to win the book. And please put the word contest in your subject line. Good luck.
So it's another week already.
I don't know where the time goes, but I know we're having fun, and that's probably why it's flying by. Yeah, it is another week. Hard to believe. And it's been a great week, and we've got a really interesting week coming for you next week. I'll tell you about that in a second. First, there's just a little bit of crossover in that interview with Stephen Gray, but it's really interesting crossover. Here's why. His poster child was Berkshire Hathaway, so BRK.B for the B shares. John Dorfman from Dorfman Value Funds was buying it back on September the 16th. So Ed Schill from Wealth Enhancement Group was buying it on June the 23rd. But then Stephen Gray mentioned Estee Lauder, ticker EL. And John Dorfman from Dorfman Value Investments was shorting it back on September the 16th. So in other words, they agreed. And this was a stock that John talked about Estee Lauder in Quick and Dirty, but Berkshire Hathaway came up for both of them as one of their poster children, one of their exemplars. And then it was an exemplar today for Stephen, but John was shorting it. And they're both value investors, right? Dorfman Value Investments, that's the name of the firm. Stephen Gray, Gray Value Management. So yeah, really interesting there. And again, that John Dorfman interview from September 16th. Then you had, during Quick and Dirty, Markel Group. I know we only go back 6 months, but it was a buy gradually today. Brian Lee from Blue Zone Wealth Advisory was buying it on April the 14th, so 6 months and 3 days ago. And then Walmart was a buy from Brian Mulberry from Zacks Investment Research back on April the 10th. So again, just over 6 months ago. And you heard what Stephen said about it today. Next week on this show, Andy Wells, Chief Investment Officer at Sanjac Alpha. David Ellison from the Hennessy Funds talking bank stocks. Steve Cucchiaro from 3 Edge Asset Management talking gold. Dave Rosenberg from Rosenberg Research. Yeah, it's going to be a great week. Plus, in the market call, we have this whole thing we're doing with Hal Lambert from Point Bridge Capital. That's the guy who runs the MAGA fund. But then the next day, we're having Brian Potts, the founder of Goods Unitas, the creator of the Democratic Large Cap Core Fund. That's DEMS. So yeah, that's going to be really interesting next week. I can promise you that. And yeah, plan to be here. I'll also talk about what I'm doing for Halloween. You know, I do the whole cash or candy thing. I also talked about that on Stacking Benjamins. If you're a Stacking Benjamins fan, you can find that there. Meanwhile, if you're looking for something to celebrate, today is National Mammography Day. It is National Edge Day, which celebrates a conscious choice for teens and young folks to live free from alcohol, tobacco, and recreational drugs. It's a straight edge lifestyle. That's why it's Edge Day. It is Black Poetry Day. It is National Mulligan Day, an opportunity to give yourself a second chance, or as some people would call it, a mulligan or a do-over. It is Wear Something Gaudy Day, but after you wear something gaudy, you may have to take a mulligan again. It is Pay Back a Friend Day. It should always be Pay Back a Friend Day. It is National Playing Card Collection Day. Yeah, I can tell you, I had a collection of lousy cards when I played poker with friends last night. Terrible. And then on the food front, it is 4 Prunes Day. Prunes, of course, are dried plums. They say you need 4 to 9 in a sitting to basically regulate your digestive tract. I'm not a big prunes guy. And it's also National Pasta Day. Yeah, any day is a good day for pasta. My guests today were John Cole Scott from CEF Advisors, cefadvisors.com. Ted Rossman from bankrate.com. Again, a direct link to get to their story that we were discussing. And Stephen Gray from Gray Value Management, Gray, Grey, grayvm.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Peter Lynch, who said, "Find something you enjoy doing and give it everything you've got, and the money will take care of itself." Well, we hope that that's what you're doing with your work life, but that's also what you should be thinking about on the weekend. Go make it that you enjoy yourself and you get some time, because that'll make everything else be easier for you to give it what you've got. So keep money in perspective, and the way you do that is by remembering, until we do this again the next time, best thing you can do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again on Money Life on Monday.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
That's all the time we have. Join us again next